While rates may head up in the U.S., Europe is in the process of additional stimulus and easing. To help us understand the dual dynamic of what is going on, we turn now to Kathy Boyle. She is president of Chapin Hill Advisors. Let's start with the market reaction today. We've seen this before in the past. Typically short-term reaction to world events like this, or a longer-term anxiety, do you think?
Well, both. Actually, very short term, because the dollar, long dollar, short euro was a very crowded trade. And today, Draghi, the joke is that they expected a bazooka and it came out with a water pistol. Yeah, well,
right? Basically, we were talking about the ECB rates. They dropped them. We're talking about negative interest rates now.
Negative interest rates, but they expected a bigger negative interest rate, again, to try to drive stimulus into the market. That's what they're all trying to do. They're trying to get the banks to lend. They're trying to get them to push the money out from holding it back. It's not working. So it's their version of quantitative easing. They expected Draghi to really hit it big to extend the...
Explain the concept of negative interest rates.
Because it means that if you leave your money in a bank, you have to pay the bank. Would you like to do that? Is that what you'd like to do with your cash?
And so the idea is to go and force you to spend it instead, or to stick it under your mattress?
To take it out and do something with it, whether these are institutions for the most part, right? Take the money out and
it's an institutional number, right? Because it's
exactly. It's not the average person that's, getting hit.
And is it not working in Europe?
It's not. It's not. They're not. Everybody's afraid of the other shoe to drop. Everybody's afraid of what's really not happening. The Fed and the government statistics, Europe and U.S., the numbers are not matching up with the sentiment and what people are seeing. Look at Greece. Look how many people are out employed. Italy and Spain had 2-year negative yields on interest rates. So today they turned everything upside down. German bunds rates went up, spiked up. The euro spiked up. Now it's 1.09, I think, is where it closed.
Yeah, the euro rallied very significantly, but that's following a very strong dollar for the last 6 months or so.
The dollar has been very strong for a long time. The dollar may be ending that trend, right? But today what happened is all these hedge funds and institutions that had a long dollar bet, short euro, they had to unwind those trades, so that exasperates the move as well. So that's part of what pushed the euro up.
Okay, and oil also rallied a little bit today, but oil could not really go any lower. It seems like that was the natural trade to make in oil.
Right. Oil had been holding that 41 level, and it broke it the other day. And, everybody's afraid. High-yield debt in the United States has also hit levels that we haven't seen since 2011, 4 years. So high yield is trading down. Rates have spiked up. The CCC index actually hit 16.5% the other day. 16.5%, we haven't seen that in a long time, right? So the spreads between that and Treasury are really widening. That can be a sign that equities are next, because high yield is a proxy for equity, okay?
Right. So Janet Yellen spoke today and said nothing.
Right. For some reason, the Fed still thinks that they need to continue on this path of raising rates. Now, the rate raise is minuscule. It's 0.25%.
It's really symbolic.
It is. It's the idea that the Fed is moving forward with this. So if rates steadily go up, even if the path is slower and longer, it means that mortgage rates go up. It means interest rates go up. And it means that if the economy is not doing well after all their dumping of the money in and quantitative easing, what's going to be the thing to lift the economy?
They have a credibility problem if they don't raise interest rates. So It's almost guaranteed at this point. And it's also saying, whether they believe it or not, that the economy is strong enough to support raising the interest rates. Do they believe it, or do you think she's just rolling the dice?
Well, a couple things. The Fed is terrified of deflation, right?
Yes.
And that's what we're really seeing. We're not really seeing inflation in a lot of goods and services, okay? And deflation sounds good because prices go down, so you and I would like to buy more.
But it's a cycle you can't stop.
Right. And for the corporation, it means they're not spending, right, because they don't have the pricing power. So the Fed is relying a very large amount on unemployment numbers. So jobless claims are good, 42-year low in terms of unemployment claims, and, 5.5% employment rate. However, the thing is, there's so many people not being counted. We have the lowest workforce participation in over 40 years. So that means that there's an awful lot of people that are able-bodied and willing to work but are not in those roles. So that becomes part of the issue. Our unemployment rate have swollen. Our unemployment Social Security is very close to running out of money. And so those are some of the Social Security disabilities.
When we looked at the inflation rate, because we did get, we're getting kind of precariously close to the concept of deflation here, aren't we? And deflation is something where the central banks have very, very little power to replace. They are terrified of deflation. Is raising interest rates the answer to that?
Well, it's not really, because it can backfire on them, right? But they feel, again, as you said, they really have a political problem here. They backed into a corner. They said they're going to raise, and they don't want to look that because Europe is still not doing well, they don't want to look like they've been backed into a corner by other countries and political pressure. So they're going to raise. Who knows what they're going to raise the next time? That'll be the next game. As we move into January 16, the guessing game will be when and how much will the Fed raise.
Kathy Boyle, very good explanation of the difference in strategy between the U.S. and European central bankers right now. Thank you.
Good to be here.
A Rise Exchange is coming right back. Stay with us.